So very good morning, sorry, very good evening to all. This side Ruby Ahuja, and today we are going to discuss about gold market fluctuation. Actually, what happened in last week fluctuations such as, and डिस्कस करेंगे कुछ नई चीज़ें और देखेंगे नेक्स्ट वीक का मूव कैसा होगा. सो डिस्कस करने से पहले फर्स्ट ऑफ ऑल लेट मी नो आप लोग को मेरी आवाज़ क्लियर है और स्क्रीन प्रॉपरली विजिबल है सो दैट वी कैन स्टार्ट आवर सेशन फ्रॉम हेयर और डिस्कस कर सके बाकी की चीज़ें. ओके सो हम लोग डिस्कस करने जा रहे हैं गोल्ड के बारे में. आज का सेशन हमारा रहेगा कि कुछ डिस्कशन पॉइंट देखेंगे, न्यूज़ देखेंगे कि लास्ट वीक कैसे चेंजेस देखने को मिले थे और आने वाले वीक में कैसे चेंजेस देखने को मिल सकते हैं. सो गोल्ड डाउन ट्रेंड, वाई स्ट्रॉन्ग फंडामेंटल्स आर नॉट एवरीथिंग. जो पॉइंट्स आज हम लोग कवर करने वाले हैं: गोल्ड डाउन टर्न, गोल्ड हैज डिक्लाइंड बेस्ड ओनली, गोल्ड स्टॉक शुड बी सोरिंग टू, gold failed to hold its gains, the broad head and shoulder patterns, XAU USD recovers above 1750, look to post large weekly losses, gold technical outlook. तो हम लोग एक एक करके ये सारी चीज़ें डिस्कस करते हैं. So on the gold chart below, I added annotations that show what happened in the previous three cases after the retail sales report. We saw the following. So gold declined after retail sales disappointment in June. Gold topped after retail sales and outperformed in July. Gold paused its rally after retail sales disappointed in August. Gold declined after retail sales outperformed in September. सो गोल्ड डाउन ट्रेंड हम लोग देख सकते हैं. गोल्ड रिटेल सेल्स -1.7% वर्सेस -0.6% एक्सपेक्टेड, बिलो एक्सपेक्टेशंस. Retail sales -0.7% versus -0.4% above expectations. Retail sales -1.8% versus -0.3% expected, below expectations. And retail sales 0.7% versus 0.8% expectation, above expectations. So the breakouts were invalidated. देख सकते हैं जिस तरीके से ब्रेकआउट आते हुए दिख रहा था वो इनवैलिडेट कर रहा था, क्योंकि जिस तरीके से अपसाइड मूवमेंट जाने की उम्मीदें थी वापस से डाउन साइड प्रेशर आते हुए दिखा और वापस से गोल्ड के प्राइसेस हम लोग को डाउन ट्रेंड टर्न में देखने को मिले. Gold has declined based only. So what should one make of that? Nothing. There is no clear link and perhaps no link whatsoever between US retail sales and the price of gold. If gold has declined based only on great retail sales, then it surely should have soared based on a disappointing Retail sales in June, right? It plunked then. So, what cold permeables might tell you? Many weeks, months, and years, I have been writing that market don't need a trigger to move in a certain way. Getting one could speed things up, but the market is right eventually rally or decline on just about any pieces of news, provided that they really want to. But market wanting to move in a given way, I mean, the fact that markets move in trend and cycles, and even if a given market has a very favorable fundamental situation for the long run, it doesn't mean that it won't slide in the short or medium term. That's how market work, and that's been the case for decades, regardless of what cold permeables might tell you. So gold stock should be soaring too. Let's face it, the monetary authorities around the world are printing ridiculous amount of money. Stagflation and it's likely next, and gold is extremely likely to soar based on that in the following years, just like what we saw in 1970. तो हम लोग अभी के डेटा को कंपेयर कर रहे हैं 1970 के डेटा से। तो 1970s में जैसे हम लोग को गोल्ड एक बार ब्रेकआउट्स देते हुए वापस से सोरिंग की ओर देखने को मिल रहा था, सेम हम लोग को ब्रेकआउट्स देते हुए वापस से सोर करते हुए दिख रहा है। But this is already the case. Lots of money has been already printed, and the world has been suffering from the pandemic for well over a year. Gold should be soaring in this environment, silver should be soaring, gold stock should be soaring too. तो हम लोग जैसे कि देख रहे हैं इस एनवायरनमेंट में भी क्या देखने को मिलेगा हमें कि लॉट्स ऑफ मनी ऑलरेडी प्रिंट हो चुके हैं, और जिसकी वजह से पूरा वर्ल्ड हम लोग का सफ़र करने वाला है पैंडेमिक की वजह से ओवरऑल इस साल भी, और उसके वजह से गोल्ड एक बार वापस से सोर करने वाला है एनवायरनमेंट में, एंड silver should be soaring and gold also start to be soaring too. Gold failed to hold its gains. So moreover, and what's the reality? Gold fails to hold its gains above to its 2011 highs. Can you imagine that? So much money printed, excessive debates, even pandemic, and gold still failed to hold gains above its 2011 highs. If it doesn't make you question the validity of the bullish narrative in the medium term in the precious metal sector, consider this. And gold stocks are not above their 2011 high. They were not even close. They were not above their 2008 highs near either. In fact, the HOI index, the flagship proxy for the gold stocks, is trading below its 2003 high, and that's in normal prices. It's in real prices, it's even lower. Just imagine how weak the precious metal sector is if the part of the sector that is supposed to rally first. That's what we usually see the beginning of major rallies is underperforming in such a ridiculous manner. एंड दैट्स जस्ट द बिगिनिंग ऑफ डिक्लाइन इन द माइनिंग स्टॉक्स। तो हम लोग देख रहे हैं कि इसकी वजह से हम लोग को जो माइनिंग स्टॉक्स है वापस से डिक्लाइन करते हुए दिख रहे हैं। जस्ट हमारे 2003 में भी ऐसा ही देखने को मिला था। एच आई इंडेक्स द फ्लैगशिप proxy for the gold stocks is trading below its 2003 high, and that's the nominal prices. Its real prices it's even lower. Just imagine how weak the precious metal sector is if the part of the sector that is supposed to rally fast is underperforming in such a ridiculous manner, and that's just the beginning of decline in the माइनिंग स्टॉक्स। तो ये सारी जो चीज़ें देखने को मिल रही हैं ये पूरी तरीके से सिग्नल है हमारी माइनिंग स्टॉक्स में डिक्लाइन का, और अगर माइनिंग स्टॉक्स हमारे डिक्लाइन करते हुए दिखते हैं तो गोल्ड हमारा जो अंडरलाइंग एसेट है वो भी एक बार डिक्लाइन करते हुए दिखेगा। सो गोल्ड स्टॉक्स की बात कर ले तो गोल्ड स्टॉक्स वापस से शार्प डिक्लाइन करने की ओर है, एंड ऑफ अ पावरफुल रैली, zigzag correction that starts another powerful rally, and end of the initial rally that is even followed by attempts to break higher, but it is actually a sharp side that triggers the rally in the new sides. The broad head and shoulder pattern की बात करते हैं, so the breakdown below the broad head and shoulder pattern was verified. The previous three similar patterns were followed by huge declines, and I copied the moves to the current situation. The simple analogy tells us that HY index could slide to the 100 to 150 range, meaning that it could even decline to its early 2016 low. That is, हम लोग देख रहे हैं कि HY इंडेक्स की अगर हम लोग एक्सपेक्टेशन करते हैं तो HY इंडेक्स हम लोग को 100 टू 150 की रेंज में भी देखने को मिल सकता है, यानी कि हम लोग की 2016 के भी लो से डाउन होता हुआ दिख सकता है. सो कैन इट रियली हैपन? With the precious metal market as weak as it is right now, from the medium term point of view, not the long term one, of course. XEU USD reverse above 1750 looks to post large 5 weekly losses. A combination of factors failed to assist gold to capitalize on its modest intraday gains. Hawkish Fed expectation rising US bond yields acted as a headwind for the commodity. तो देख सकते हैं हॉकिश फेड एक्सपेक्टेशन हम लोग को देखने को मिल रही है, और उसकी वजह से एक बार हम लोग का करेंसी स्ट्रांग होने की उम्मीद, जिसकी वजह से गोल्ड को वापस से डाउन किया जा रहा है, और गोल्ड हमारा 1750 से थोड़ा सा रिकवर करते हुए इस टाइम पे देखने को मिल रहा है. COVID-19 woes softer USD did little to impress bulls or provide any impetus to the metal. Thursday's sharp decline. So, following Thursday's sharp decline, the USD XAU USD pair managed to stage a rebound on the first half of the day on Friday. So, after climbing to a daily high of 1767, however, gold lost its traction in the early American trading hours and dropped below 1750 amid renewed USD strength. So, after climbing to a daily high of 1767, however, gold lost its traction in the early American trading hours and dropped below 1750 amid renewed USD strength. तो हम लोग देख रहे हैं कि थर्सडे को जो शार्प देखने को मिला, सो थर्सडे को जो हम लोग को डिक्लाइन देखने को मिला, उसमें अमेरिकन सेशन यानी कि शाम को 5 बजे के पहले गोल्ड के प्राइसेस 1767 के लेवल्स पे आ चुके थे, और जैसे ही अमेरिकन सेशन ओपन होते हुए दिखा, यूएसटी की स्ट्रेंथ आने के बाद 1750 तक के टारगेट्स देखने को मिले। Nevertheless, the risk-averse market environment, as reflected by a 0.9% decline in the S&P 500 index, seems to be helping the precious. Nevertheless, the risk-averse market environment, as reflected by a 0.9% decline in the S&P 500 index, seems to be helping the precious metal find demand as safe haven and limit its losses. As of writing, XEU USD was virtually unchanged on the day at 1754 but was down 1.9% for the week. तो हम लोग देख रहे जिस टाइम पे ये न्यूज़ लिखी गई उस टाइम XEU USD हमारा 1754 पे मूव करता हुआ दिख रहा था और वीकली बेसिस की बात करें तो वीकली बेसिस पे 1.9% की गिरावट के साथ. So gold struggled to preserve its intraday gains. Gold struggled to preserve its intraday gains and dropped to the lower end of the daily trading range during the early American session. So देख सकते हैं जिस तरीके से गोल्ड हमारा इंट्राडे गेन्स बनाते हुए दिखा, लोअर एंड पे आते हुए दिखा हम लोग को अमेरिकन सेशन में, क्योंकि अमेरिकन सेशन में हम लोग को रिटेल सेल्स और रिटेल सेल्स की डेटा आते हुए दिखे और वो भी हमारी यूएसटी को पूरी तरीके से स्ट्रेंथ में कन्वर्ट करते हुए, जिसकी वजह से गोल्ड हमारा 1750 के बिलो आते हुए दिखा. So the USD dollar witnessed a modest pullback. The USD dollar witnessed a modest pullback from 3 week top until touched on Thursday, which was seen as a key factor that extended some support to the dollar denominated commodity. However, renewed speculations about an earlier policy tightening by the Fed acted. So, however, renewed speculation about an early policy tightening by the Fed acted as a tailwind on the greenback. This in turn keep a lid on any further gains for the non-yielding gold yellow metal, rather prompted some fresh selling near 1767 and 1768 regions. तो देख सकते हैं जिस तरीके से नॉर्थ अमेरिकन सेशन खुलते हुए दिखा 1767 1768 की रेंज से वापस से करेक्शन और वापस से गिरावट का माहौल बनते हुए हमारे येलो मेटल वापस से सेलिंग प्रेशर में आते हुए 1750 तक के लेवल पे देखने को मिला. So US retail sales data underscored consumer confidence. Thursday upbeat US retail sales data underscored consumer confidence and pointed to the continuation of economic recovery. Investors now seem convinced that the Fed would eventually begin rolling back its massive pandemic era stimulus later this year. This was reinforced by a fresh leg up in the US Treasury bond yields, which further underpinned the greenback. So this was reinforced by a fresh leg up in the US Treasury bond yields, which further underpinned that greenback. तो हम लोग देख सकते हैं जिसकी वजह से इसका पूरा इम्पैक्ट हमारे यूएस ट्रेजरी यील्ड्स पे देखने को मिला और यूएस ट्रेजरी यील्ड बॉन्ड हमारे वापस से राइज करते हुए दिखे. So in fact, the yield on the benchmark 10-year US government bond climbed back to the 1.35% threshold. तो देख सकते हैं यूएस ट्रेजरी यील्ड्स हम लोग कितने राइज करते हुए दिखे 1.35% की वापस से तेजी के साथ देखने को मिले. Hence, the next most important event for gold prices will be the FOMC monetary policy meeting on 20 to 21 सितंबर. तो हम लोग देख रहे हैं गोल्ड के लिए हमारा जो नेक्स्ट मूव होगा वो पूरी तरीके से डिपेंड करेगा हमारे इम्पोर्टेंट इवेंट पे जो कि सितंबर 20 टू 21 पे होने वाला है. डिस्कस करेंगे मार्केट पार्टिसिपेंट्स न्यू लुक फॉरवर्ड. उसके पहले एक बार क्लियर कर दीजिए आप लोग को अभी तक सब कुछ क्लियर हो रहा है. इफ यस काइंडली प्रेस 15. प्रेस 15 अगर आप लोग को सारी चीज़ें क्लियर हो रही हैं ताकि हम लोग आगे की चीज़ें डिस्कस कर सकें. So market participants now look forward, meanwhile firming expectation for an imminent Fed taper announcement, along with persistent worried about the Delta variant and a global economic slowdown, weighed on the investor sentiment. This was evident from the prevalent cautious mood around the equity markets. This might turn out to be only factor that could help limit any deeper losses for the safe haven gold, at least for the time being. तो हम लोग देख सकते हैं जो इकोनॉमिक स्लोडाउन और डेल्टा वेरिएंट की बात है उसकी वजह से एक बार हम लोग का गोल्ड अप आ सकता है और डीपर लॉसेस में नहीं जा सकता है अभी के टाइम के लिए। अदरवाइज वापस से गोल्ड हम लोग को 1600 की रेंज में आता हुआ देखने को मिल सकता है। Market participants now look forward to the release of the Michigan Consumer Sentiment Index for some short-term trading opportunities on the last day of week. तो देख सकते हैं मार्केट हम लोग देख सकते हैं मिचिगन कंज्यूमर सेंटिमेंट इंडेक्स इसके हम लोग रिजल्ट्स अगर हम लोग कल की बात करें तो वो हम लोग के गोल्ड के लिए पॉजिटिव होते हुए दिखाता और कुछ हम लोग की लास्ट वीक में कुछ हम लोग को ऐसे डेटा देखने को मिले थे जिसकी वजह से थोड़े से बाइंग प्रेशर वापस से आते हुए दिखे थे एटलीस्ट फॉर 2 to 3 मिनट्स और वापस से सेलिंग प्रेशर स्टार्ट होते हुए दिखा। सो गोल्ड टेक्निकल आउटलुक की बात करते हैं। सो दी ओवरनाइट स्लम्प below a strong horizontal support near the 1780 shifted the near term basis bias back in favor of bearish traders. The emergence of fresh selling on Friday adds credence to the negative outlook and support prospects for further losses. Moreover, technical indicators on the daily chart have been drifting lower and are still far from being in the oversold territory. Hence, a subsequent decline towards the next relevant support around the 1729 to 1727 region remains a distinct possibility. The downtrend trajectory could further get extended and drag gold back towards challenging the 1700 राउंड फिगर मार्क। तो हम लोग देख सकते हैं अगर इसके बाद डिक्लाइन आती हुई दिखी तो 1729 1727 एक रीजन होगा एक अच्छा सपोर्ट और उसको अगर ब्रेक करते हो तो 1700 के जो साइकोलॉजिकल लेवल है वहां तक के लेवल्स हम लोग को देखने को मिल सकते हैं। अदरवाइज हाइस होते हैं तो अपसाइड हम लोग को जो रेजिस्टेंस है वो 1780 के आसपास देखने को मिल सकते हैं। So on the flip side, the daily swing highs around the 1767 to 68 region now seems to act an immediate resistance ahead of 1772 to 74 region. तो हम लोग देख सकते हैं जिस तरीके से 70 अभी जो मूव देखने को मिलता है 1767 68 रीजन एक शॉर्ट टर्म रेजिस्टेंस की तरह काम करेगा गोल्ड के लिए और अगर उसको ब्रेक करता है तो 1772 और 1774 का जो रीजन है ये अगला रेजिस्टेंस होगा। So any further recovery should be seen as a selling opportunity near 1780 सप्लाई ब्रेक पॉइंट। तो हम लोग देख सकते हैं और अगर उसके बाद रिकवरी देखने को मिलती है तो 1780 एक ऐसा लेवल होगा जहां से वापस से सेलिंग प्रेशर भी बन सकता है और अगर उसको क्रॉस करता है तो 1800 तक के टारगेट्स that set some follow through. Buying might trigger a short covering move and allow gold to aim back to reclaim the 1800 mark. This is closely followed by the very important 200-day simple moving average around 1808 to 1810 region, which could cap the upside for XUUSD. तो हम लोग देख रहे हैं कि अगर 1780 के लेवल को ब्रेक करता है तो 1800 का साइकोलॉजिकल लेवल, और उसको ब्रेक करते हुए 1808 टू 1810। जो टेक्निकल आउटलुक की बात करें तो गोल्ड हमारा 1751 के लेवल्स पे, अगर इसको ब्रेक करता है तो 1727 हमारा जो सपोर्ट लाइन है। लेकिन अगर अपसाइड मूवमेंट की बात करते हैं तो 1780 और उसके ऊपर 1800 और 1808 टू 1810 के रिजल्ट्स। सो हम लोग डिस्कस करने जा रहे हैं अब अपना गोल्ड न्यूज़ netania.com, और उसको डिस्कस करने से पहले एक बार क्लियर कर दीजिए अभी तक सब कुछ क्लियर हो रहा है। इफ यस काइंडली प्रेस 30। प्रेस 30 अगर आप लोग को अभी तक सब कुछ क्लियर हो रहा है, ताकि हम लोग आगे की चीज़ें डिस्कस कर सकें। ओके, सो गोल्ड netgenia.com पे गोल्ड के प्राइजेस देखते हैं तो 1753.40 पे प्राइजेस अभी मूव करते हुए। ये फ्राइडे क्लोजिंग की डेटा है। रेंज जो देखने को मिली थी 1746.40 का लो बनाते हुए 1767.48 तक का हाई, अपने डेली ओपन से 0.02 पॉइंट्स की गिरावट के साथ और 0.38 पॉइंट्स की गिरावट के साथ। फ्राइडे की ओपनिंग देखने को मिली थी 1753.88, क्लोजिंग 1753.78। ईयर वाइज चेंजेस की बात करें तो 141.48 पॉइंट्स की गिरावट के साथ। ईयर वाइज परसेंटेज चेंजेस की बात करें तो 7.47%। 52 वीक्स हाई की बात करें तो 1965.55, 52 वीक्स लो 1676.10. सो गोल्ड न्यूज एफएक्स स्ट्रीट से हम लोग बात करते हैं. So gold news FX Street, XAU USD surrenders intraday gains drop closer to 1750 levels. Gold struggled to preserve its intraday gains and dropped to lower end of the daily trading range during the North American session. So the overnight slump below new horizontal support near 1780 shifted the near-term bias back in favor of bearish traders. The emergence of fresh selling on Friday adds credence to negative outlook and supports prospects of further losses. Moreover, technical indicators on the daily chart have been drifting lower and are still far from being in the oversold territory. Moreover, technical indicators on the daily chart have been drifting lower and are still far from being in the oversold territory. Hence, a subsequent decline towards the next relevant support around the 1729 to 27 region remains a distinct possibility. The downtrend trajectory could further get extended and drag gold back towards challenging the 1700 round mark. On the flip side, the daily swing highs around 1767-68 region now seems to act as an immediate resistance ahead of the 1772 to 74 region. Any further recovery would be seen as a selling opportunity near the 1780 support breakpoint. That said, some follow through buying might trigger a short covering move and allow gold to aim back to reclaim the 1800 mark. This is closely followed by the very important 200-day simple moving average around the 1808 to 1810 region, which should cap the upside for the XEU USD. बात करेंगे फंडामेंटल ओवरव्यू की. दो मिनट में हम लोग डिस्कस करेंगे गोल्ड के फंडामेंटल्स ओवरव्यू की और देखेंगे फंडामेंटली गोल्ड हम लोग का कहाँ मूव कर रहा है और कहाँ मूव करता हुआ दिख सकता है. So, gold fundamental overview. Gold struggled to preserve its intraday gains and dropped to the lower end of the daily trading range during the North American session. The dollar witnessed a modest pullback from the 3 week top touched on Thursday, which was seen as a key factor that extended some support to the dollar denominated commodity. However, renewed speculations about an earlier policy tightening by the Fed acted as a tailwind for the greenback. This in turn kept a lid on any further gains for the non yielding yellow metal, rather prompted some fresh selling near the 1767 to 68 region. Thursday's upbeat US retail sales data underscored consumer confidence are pointed to the continuation of economic recovery. Investors now seem convinced that the Fed would eventually begin rolling back its massive pandemic era stimulus later this year. This was reinforced by a fresh leg up in the US Treasury bond yields, which further underpinned the greenback. In fact, the yield on the benchmark 10-year US government bond climbed back to the 1.35% threshold. Hence, the most important event for gold prices will be the FOMC monetary policy मीटिंग ऑन सितंबर 2021। तो हम लोग देख रहे हैं जिस तरीके से इस बार जो 21 सितंबर को हम लोग को जो डेटा देखने को मिलने वाला है यूएस मॉनेटरी पॉलिसी मीटिंग, उसकी तरीके से पूरा का पूरा इम्पैक्ट देखने को मिलेगा गोल्ड पे कैसा पड़ेगा और यूएसटी की स्ट्रेंथ पे कैसा मिलेगा देखने को। Meanwhile, firming expectations for an imminent Fed taper announcement, along with persistence worried about the Delta variant and a global economic slowdown, weighed on investor sentiment. This was evident from the prevalent cautious mood around the equity markets. This might turn out to be the only factor that could help limit any deeper losses for the safe haven gold, at least for the time being. Market participants now look forward to the release of the Michigan Consumer Sentiment Index for some short term trading opportunities on the last day of the week. So 1 week की average forecasting देखते हैं तो 1751.67, for 1 month it should be 1758.86, for 1 quarter it is 1776.50. सो हम लोग एक डेटा देख रहे हैं. If post 1971 monetary policy system is bad, why isn't gold higher? So August marked the 50th anniversary of Nixon's abandonment of the gold standard. August marked the 50th anniversary of Nixon's abandonment of the gold standard. It caused to the so many problems of the economy and gold didn't take over. Last month marked the 50th anniversary of President Nixon's suspension of the convertibility of US dollar into gold. This move broke the last thin link between world currencies and the yellow metal, effectively ending the ersatz of the gold standard that we will still had back then. So last month marked the 50th anniversary of the. Okay, so I wrote about the collapse of the Bretton Woods in the last edition of the gold market overview, but it was a truly revolutionary event that paved the way for today's. So you see, as weak the diluted post-war version of the gold standard was, it limited the U.S. central bank's ability to increase the monetary policy, as there was still a possibility that other participants of the system would redeem their dollars for gold. But Nixon suspended temporarily the convertibility of the dollar into gold, and while gold is away, the mice will play. Without any true constraints, the pace of annual money growth hit double digit. The CPI inflation rate followed, and the great stagflation of 1970 emerged, as the chart below shows. So हम लोग डिस्कस करने जा रहे हैं गोल्ड न्यूज kitco.com. सो हम लोग डिस्कस करेंगे इस डेटा को, जो कि हमारी छोटी सी क्लिप है आप लोग की स्क्रीन पे, इसको देखेंगे।
Kitco News special coverage of the Precious Metals Summit is brought to you by Corvus Gold.
We're continuing our coverage at the Precious Metals Summit in Beaver Creek. Here with me is Dan Oliver, founder of Mermican Capital. Welcome
Thanks
back.
for having me again.
You're famous, no chef, for calling $10,000 gold. You're
We'll get there.
10K gold man. Let's talk about that again this time. But first, I want to talk about some of the other macro variables that you brought up to me offline.
Sure.
One of them was interesting to me. A credit collapse, a potential credit collapse. Now that could take on many different forms. So what do you mean by that?
Yeah, so I mean, this is just straight, literature von Mises, which is that what happens in the bank system is you go to the bank with $100, you deposit at the bank, and they lend out $10,000. That's how the fractured banking system works. And that $10,000 or $1,000, whatever the multiplier is, goes into the asset markets because that's what banks lend against. And so you get rising asset prices. And so when prices, in a free market, increasing price equals scarcity. So entrepreneurs run out and they start constructing all sorts of new assets, and what you wind up with overcapacity. And when you have overcapacity, rents go down, right? You can't charge the same amount for your service if you got too much of it. And then the companies that invest in these things can't make their cash flows, they can't make their payments to the bank, they blow up, the bank blows up. And in the 19th century, going back thousands of years, that was the end of the story. Everyone went broke, and then 18 months later, people picked up the pieces and moved on. But now we have something called the Federal Reserve, and they run in, and they recapitalize the banks, they print up new reserves, give them to the banks, and the system goes on only worse because now the banks have more capital to invest in more fixed assets. And so what you see in the US and China and everywhere there's a credit bubble, you see massive overinvestment in fixed capital. And by the way, the same thing happened in Weimar Germany, right? It was the same thing. They had interest rates sharply negative. You had people investing not in consumer goods, but in capital. And you keep doing that. And Venus's point was eventually what happens is either you abandon the project and you wind up with the 1930 situation where all this overcapacity liquidates, you get a depression, or you keep printing the money till the currency evaporates and you wind up in hyperinflation. And then you get a depression anyway, you just get an inflationary depression instead of a deflationary depression.
Isn't the purpose of the Federal Reserve to prevent that kind of scenario from happening? They are the lender of last resort, after all.
Well, they can prevent a deflation or collapse, and that was the famous speech by Bernanke, where he said that the U.S. has a technology called a printing press, and he said this, right, that they could always produce positive inflation to avoid the debt collapse that was the 30s, right? But again, what the Austrians would counter is, yes, you can do that, but at the cost of tanking the currency one day, Weimar style. And that's where we're sort of headed. We're not there yet. It'll take a time to get there, but that's where we're headed ultimately.
What do you think about monetary policy right now? What directions, what options does the Federal Reserve have, given that inflation is currently at 5%? It's interesting because we talked last, you and I, in February, and I asked you, what would happen if inflation gets to 4 or 5%? Well, we're there now, Dan.
Yeah, well, and of course, as we all know, we're not really at 4 or 5%. We're more like 12% because the numbers are cooked. Sure. They keep changing the CPI because all sorts of payments are based on CPI. So by cheating, they can reduce the payments. But no, I think the Fed's in a real box, right? Because it's interesting. There's a schism inside the Fed, which you can see. The Federal Reserve governors that come from the regional banks, and they spend all day long talking to companies in their regions. And the companies are calling up, complaining about input prices and saying, look, we're getting crushed on margins because input prices are going up. You got to stop the money printing, you got to taper. And so all kinds of speeches by regional Fed governors saying, hey, we got to taper. Then you shift over to the DC folks, the New York Fed, with all the financial people, and they say, look, all the economic numbers are terrible, right? Unemployment the employment numbers were horrible last week. Housing prices are weak. Commodities are actually weak in some sectors, lumber, for example. So they're saying, hey, look, we're missing aggregate demand here. Let's not repeat the mistake of 1937, where we tapered too soon, the monetary easing. And so you've got this confidence in the Fed, and the problem is that if they print more, you're going to see more inflation. You're going to see more cost of business going up. If they stop printing, you're going to see the asset markets melt down. And so if you're a Fed, what do you do? It's a really, really bad choice, and this is the box they put themselves in.
Well, back in 2013, when the Fed then announced tapering, we had what we now call a taper tantrum. Yeah. The stock markets reacted adversely. We had a shoot up in the bond yields. None of that happened this time. After Jackson Hole, we did not see an adverse market reaction from the stock markets. We did not see bond yields tick up. We didn't even see gold move dramatically. What happened?
Well, there are two ideas I have on that. One is, A, the market doesn't believe the Fed, which is certainly possible because they do a lot of talk, but in fact, they're still printing $120 billion a month. And actually, if you look at a 8-week rolling average of the money printing, it's accelerating. It's actually going more. So they talk about tapering, they're actually printing faster. The other thing is that the people, I think, forget and should remember is that the Fed doesn't blow bubbles. The Fed gives the banks reserves, and the banks use those reserves to blow the bubbles. The banks blow the bubbles. And so, same thing when liftoff happened in 2016 under Yellen. Everyone thought, oh my God, rates are going up, the market's going to tank. Well, no. The banks were so chock-a-block full of reserves, you don't need more reserves. And so, the banks went merrily on their way, funding things in the bubble. The everything bubble kept going. So I think that the tapering isn't that important for the bubble. What's more important is the banks have tons of reserves. They've got to find people to lend it to, right? The Fed is all about credit growth. Well, I mean, it's great to buy Fannie Mae debt because it's quasi-guaranteed by the state or treasury bonds, but how many small businesses out there are in a position to borrow money right now? Or even individuals, even consumers, as all the stimulus disappears, or the eviction moratorium goes away, right? Unemployment is not recovering. So the banks have all these reserves, they got nowhere to put them, and that's a real problem for the Fed.
Well, why wouldn't you take advantage of low rates right now if you're a consumer or a small business?
Well, if you can get it, right? I mean, if you're already rich, they'll lend you tons of money. You don't really need it, right? If you're not rich, you're not doing well, they won't lend you the money.
Right.
So, I mean, it's not a situation like we had in, 2004, right, where subprime people were getting credit, or the goldfish were getting credit, cats and dogs would get credit applications, right? Or even 2013, that started happening again, right? Now, because of the continuing COVID disaster of the government response on the economy, there are very few people who are eligible to borrow money. So the banks have tons of reserves; they don't need more, but there's no one to lend to.
Let me ask you this: do you think interest rates would rise naturally? The 10-year yield, for example, or even the 30-year yield would rise by themselves, even if the Fed takes no action?
Well, okay. The problem with the treasury bond market is that you've got the Democrats in firm control of D.C., right, and they want to spend a lot of money, right? And so that's going to come from somewhere. Well, it's not coming from tax revenue, and especially not coming from tax revenue if the market tanks. It looks like the market's very toppy. Again, the market is challenged with rising costs and declining revenue. There are all sorts of profit warnings that are already arriving. And in fact, I'd point out that the Atlanta Fed does a GDP Now figure where they purport to be able to tell on a day-to-day basis where GDP is for Q3, or an ongoing thing. It was at 6.2% mid-August. It's down to 3.7%. Mm-hmm. So it had a major decline. And so again, you got to ask yourself, is the Fed really going to taper into the face of weakening GDP, weakening employment, all these bad economic figures? And it's hard to imagine they're going to.
Bottom line, markets don't believe any tapering talk right now.
I think it's a stretch, but again, if they do taper, I think you'll see asset market. Of course, asset markets are going to run into trouble anyway because because margins are having such problems, right? You've got revenue problems, you've got cost problems, and so the market tanks. What's the Fed going to do? The whole system relies on rising asset prices, right? Prices go up, you sell it, you pay capital gains tax, it funds the treasury property. And back to your question, the point is, if the Fed stops printing the money, who's going to buy the treasury bonds? What's going to happen to interest rates when the treasury has to issue all these treasury bonds to fund the state, and the Fed's not buying? Who's going to buy all those things?
Excellent question. Who do you think?
Well, I don't think people will. I think the rates go up, right? And again, I mean, you don't need rates to go up very much, given the current debt loads, not just of the government, but of people, of corporations. You cast your mind back to 2019, and what I've been talking about for the previous couple of years was the corporate debt bubble, right? The big issue then was not housing bubble the way it was the previous thing. It was all the levered loans and all the problems in the corporate bond markets, and that was starting to melt down. You saw that in the repo apocalypse in mid-September, right? And what did the Fed do? The Fed ran in and started printing money in September of 2019, long before the COVID virus showed up, right? So we were already in that problem. And what happened was all those corporate debt problems got papered over because the Fed boosted the money supply from $4 trillion to now $8 trillion. Right. And so that was put on hold. But you look around the corporate sector, they still have all this debt. In fact, they took on more debt because the ones that could did. Mm-hmm. And so if the economy weakens at all, you're still going to have that incipient corporate debt problem. And now you've got other credit problems too.
All right, so we're going to get to your gold outlook in just a bit. Sure. But first, let's talk about Fed policy now. They have two mandates, so let's narrow down on both of them, inflation and full employment. Let's talk about the labor market first. So we're not yet quite at full employment. What's keeping us there? From getting there?
Yeah, well, it's interesting. If you look at the aggregate figures, the job openings that the Bureau of Labor Statistics report is like 10 million job openings and about 7 million employees. You're like, well, I don't get it. I mean, why can't they all get jobs? And there are a couple answers to that. One is that just because there's a job opening doesn't mean enough skilled people to take it. And one of the real problems in society is, of course, is like drug use, right? And the mining industry, for example, I talked to CEOs of mining companies that cannot find workers because they all fail the drug test. And so there's a mismatch of skills. There's a societal problem. And the other thing is the Fed. The Fed's response to COVID was to give people a lot of free money and to say you don't need to pay your rent for a while with all the eviction moratoriums. So a lot of people got a ton of money, and which they've been spending down. Saving rates have gone down a lot, but they still have this money. And one of the things the Fed has done, it's made it impossible for individuals to invest their capital productively, right? If you're a Wall Street shark, sure, you can make money. But if you're an individual, you put your money in the bank, you're going to get crushed by inflation. You try to play the markets, the sharks can eat you alive. All these banks of MIT scientists, trading against you. What are your chances against that? Very little. And so, there's no mechanism for people to save their money, so they spend it. And so if you just got a whole mess of money in your account from the federal government, why would you go work until it's all gone? And so I think that part of this unemployment problem is hangover from the government's response to COVID.
You don't think it's a result of stimulus checks keeping people from...
No, it is. That's my point. And they still have it in their account. They're spending it down. But until they spend it down to zero, they're not going to go back to work because a lot of these jobs aren't that much fun.
The GDP grew significantly in the last 2 quarters, yet the labor market is still not at full employment. So how did that? What was the mismatch?
Yeah, well, I mean, you look at real GDP.
Yeah.
It's more or less where it was in Q4 2019. So we really have had no real growth in that time period. And I would point out again the last numbers, wage growth was at 4%, which sounded great, but official inflation was up 5.4%. Right. So officially, consumers, their income went down by 1.4% on a real basis. And again, as I mentioned, we all know inflation is really running at more like 10 or 12% or higher on certain things. So in fact, real wage growth is negative.
It's an interesting statistic I've seen online is that personal income, household income over the last year has actually risen because of the stimulus check.
Of course.
So, but how did that translate to GDP growth and economic activity, consumer spending?
Well, that translates people go spend the stimulus money on.
I was showing you this chart. Personal savings skyrocketed last year,
right,
and it came way back down.
Well, that's right. That's because you got stimulus money and the economy was shut. There's nowhere to spend it, so of course you had to save it. Yeah, but again, there's no. See, in a normal capitalist society, every individual saves their money, or to the extent that they want to. And what that does is when you save your money, presumably it funds some investment and you get more purchasing power later. And that's the basis of a capitalist society. And what you see in every big inflationary economy, whether it's Weimar Germany, whether it's Austria of the 1820s, whether it's Rome, right? Once you take away the ability for people to invest their capital, they don't. They spend it all. And I mean, for me, for example, drugs is the perfect example of current consumption, right? And so I think it's no accident that when you see the Fed making it impossible for people to invest their capital, invest in themselves, that they turn to immediate consumption. That's terribly destructive to not just the economy, but to society at large.
Well, small businesses contribute to 40 to 45% of national GDP, depending on the year you're looking at, the study you're looking at. Are you concerned about the health of small businesses in America right now? Last year, obviously, great tragedy. Many people were forced to shut down. You're looking around. Are you seeing the recovery that you're expecting right now?
The last figures I saw, so that a third of small businesses don't think they'll make it until next year.
You're talking about till 2022?
Yeah.
Wow.
A third.
Why not?
Right. Well, because of all the issues, right? I mean, if you're a little restaurant in New York City, and all of a sudden they put all these mandates on you, who you can serve to, and you can't find labor, and you can't find inputs, right? I mean, you buy your food to make your meals, and it's not there.
It's not a demand issue; it's a supply and logistics issue.
It's both, right? I mean, it's both. People aren't going out as much. Airline tickets, for example, in this whole Delta wave have collapsed again, right? And then these airlines apparently, well, this happened to my flight home, but they can't find people to fly the plane. So they're playing planes around, but you can't find people to clean the plane or fly the plane. So the
problem is still Delta. The Delta.
Well, yeah, there's lots of problems. I mean, for example, the normal cost to send a container from China to the U.S. is about $2,000 a container. And if you're a small business, you might have a small shipment that take a quarter of that container, let's say, right? Sure. Now, Amazon has long-term contracts. And so the spot price for a container across the Pacific is going to 20,000. It's gone up 10 times.
That's right.
So if you're a small business, you're paying that. If you're Amazon, you're not paying that. It's gone up, of course, but you get these long-term contracts, so you're insulated from that for a period of time. Now, what does that do to the relative competitiveness of a small company versus a big company? And of course, it destroys it. And by the way, this had already happened. Think about it. I mean, the Fed went around during the COVID times and the first panic. And what they do, they guaranteed all the corporate debt. Well, to have corporate debt, listed corporate debt, you've got to be a huge company. So the Fed essentially guaranteed the financing of huge companies. You're a little guy, you didn't get that treatment. So a lot of little guys went underneath. And what happens? Either the big guys get the customers, the big guys buy their assets for a song. So again, part of this whole COVID panic has been to create even more industry concentration and wealth concentration than we had before. It was already getting bad, but now it's a lot worse.
Yeah. You brought up inflation a couple of times. Let's talk about that. We're already at the highest level of inflation since 2008. If you just take the official government numbers, not even the shadow stats or off the record calculations. But why hasn't gold? Well, let's tie this back into gold. Why hasn't gold performed as well as one might think it should during a high inflationary environment?
Yeah. So so gold is more concerned with monetary developments, and what gold really measures is the value of commodities, and commodities the first step in every consumer product starts as commodities, and so it's interesting in gold standard eras, when all the intermediate producers have their contracts in gold terms, gold and consumer prices go up and down together. I mean, the consumer prices are stable in terms of gold. When you have a fiat currency system, that is not the case, because the value of consumer products have all these other factors into them, again, supply chain issues and the ability to get workers and service things and apply the new mandates the government mandates to you that gold doesn't reflect. So I think gold has done pretty well. I mean, gold was $1,400 an ounce just a couple of years ago. It got to $2,100 almost, back to 18 now. I mean, that's not terrible. I mean, to think about the broader perspective. And I think, again, the market is nervous about the near future. And one thing to keep in mind is cast your mind back to February of 2020, right? Now, let's say you knew it was going to happen, the COVID panic, and you knew the Fed was going to print. You would have bought gold all day long. Well, what happened? Gold got slammed in March, right, as liquidity went away. And the gold stocks got crushed, right? Now, that was the time to buy because you knew the Fed was going to come in and start printing money. But in that panic, it doesn't matter what your view is for the long term. If you're getting a margin call, you got to sell, right? And that's what happens. Before the 2008 panic, the Fed's balance sheet was $800 billion. There was $800 billion of base money supporting the whole debt pyramid. Then it went to $3 trillion. Now it's at $8 trillion. It sounds like a lot. It is a lot. But don't forget, there's about $80 or $90 trillion of nominal dollar debt out there that requires interest payments and repayments, and only $8 trillion to maintain that. So when the Fed raises interest rates or stops printing money, that debt demands all those dollars all at once. And so you get a short squeeze on currency. The dollar goes up, asset prices go down. And again, it doesn't matter where gold is going long term in that moment. You're getting a margin call, you got to sell your position. So I wonder whether gold is telling us that the liquidity position in the market isn't doing so hot. I don't think it's telling us what the long-term future is, because the long-term future is the dollar is going down, gold is going up. And that is just the course of empire. I mean, that's just what happens to these things. And Afghanistan is an example of the empire not doing so hot, right? But again, the short term is more based on liquidity in the markets, assessment of what liquidity conditions will be in the near future.
I think investors are worried. Well, not maybe worried is the right word, but they're wondering what the core drivers of gold right now are. If you look at, let's say, traditional drivers of gold, like the real interest rates, for example. Now, real interest rates have been negative for quite a while.
That's right.
And you would think that the more negative they become, the higher gold would be propelled upwards, because they have traditionally held a very close negative correlation with each other. That has recently diverged. Do you have an explanation?
Well, yeah,
as to why?
that's certainly, we look back at the 70s, that's what happened. And what's interesting was when nominal rates went up in the 70s, real rates went down because inflation went crazy. And that's the moments when gold went crazy. But there wasn't the same level of debt in the system that was going to potentially create a crash. And again, I mean, I agree with that chart. I think gold is going a lot higher. But if we're on the verge of a policy mistake, right, if the Fed does taper in the next month or two or three, I can see the broader markets having a real problem, right? And gold will reflect that. Gold will go down. It always does. It did in 2008. It did in 2020. But again, it comes out fastest and hardest, right? In fact, what would really drive gold up to the next level, like the $3,000 level, would be a panic, right, where gold goes down, and then the Fed shows up and says, hey, 120 trillion, hey, make it 500 trillion or a billion a month, whatever the new QE is, or some other novel policy they haven't even announced yet. I mean, that is what we got gold going to the stratosphere. So it's not necessarily a terrible thing. And I think the key thing that I try to do to survive the markets is separate value from liquidity, right? And as we talked offline, if you want to bet on rising asset prices and a falling dollar, if you buy stocks on margin, right, seems smart, okay, and there's a big crash, you get liquidated immediately. Like interactive brokers will just sell you out in a nanosecond, right? If you buy a house and lever it up, there's no margin call. You can't do that. You got to miss your payments for like 2 years, and it takes a year to evict you, right? So you've got all that time, and you have to work liquidity. You can have the long view, right? And so in gold, my advice is
endorsement to miss your payments in your home.
No, but my point is that there's no liquidity risk of that with that bet, right? And so if you're buying gold on margin, you really care what's going to do next month, because that could wipe you out. If you're buying it with equity and you hold the thing, or mining companies, for example, that don't have a lot of debt, then it's unpleasant, but you don't have to worry about the near term. You can focus on the value and the long term, and that's the key.
That leads me to my next question, which is substitutes for gold. We are at a gold conference, a precious metal summit. Suppose, hypothetically, if gold disappears tomorrow and there's no more gold on the planet, what will we be talking about instead? What would you invest in?
Yeah, so gold is free market money, and it's free market money because of its liquidity profile, right? I mean, the function of money is to make barter more efficient, more to lower the cost of exchange, essentially. And if you look back at monetary history, there was a time when there wasn't enough gold to make that happen. In fact, gold has only been real money for about 200 years. Before that, it was silver, and actually, there was about a 1,000-year period, or maybe 2,000-year period, where gold and silver were both money for different functions. So gold is very, very valuable. So you would use it to ransom back your king or buy a ship, things like that. If you went to buy a banana with a gold coin, right, your change would fill a wheelbarrow. I mean, it would be a pain. And so gold was used for capital transactions, and then silver was used for goods transactions. Again, if you try to buy a ship with silver, it would just overwhelm the volume. And so they have those two different attributes. And so to answer your question, if gold went away, we go back to silver, which was money before gold. In fact, I found a quote by Xenophon in the 4th century BC where he talks about the fact that gold is not as stable as silver, because when a shipload of gold came in, the price went down. When a shipload of silver came in, nothing happened to the price, which is a remarkable, I think, a historical account of understanding liquidity. Before silver's copper, grain was money, or cows in ancient Greece. Salt, a little bit salt, but basically went from grain or cattle in a nomadic society to the metals.
Well, we've seen technological improvements over the last couple of decades leading to the digital age, and now we have digital money, cryptocurrencies. Do you think cryptocurrencies and digital cash could replace the role that silver served 200 years ago?
Yeah, you can call it money if you want. That's your right. I think now my view is that the digital so-called currencies lack the key component of money, which is stability. Right, and as I mentioned, with the reason gold stabilizes commodity prices is because when there's too little gold, right, and gold gets really expensive, the marginal mine opens up and produces more of it. Right, and the other way around, right? When gold gets too plentiful, it gets too cheap, mines shut. So there's a natural way to regulate the price of gold, and the inputs to mining are commodities: rubber, steel, labor, all those things. And so it keeps commodity price and gold pretty well anchored together. And as I mentioned, that's a good thing, because all products come from commodities, and so that stabilizes gold over the long term in commodities. And if you look at just statistically the volatility of oil, for example, in gold terms, it's much lower than in dollar terms. It's also lower in copper terms and silver terms, but it's the lowest in gold terms. So and the point of all this is that if you price oil in Bitcoin, the volatility goes not just up, it goes up to ridiculous levels, right? And so unless there's a theory about why these cryptocurrencies are going to become stable and make real things in the economy stable in terms of those instruments, then they simply don't serve the function of money. They might be great speculations, and I think Bitcoin can go a lot higher as a speculation. I don't think it can be money, because there's no theory as to why it would become stable. Now, I do think, to your point actually, private banks, before the money was captured by the government, made legal tender laws, would issue private notes that represented gold in the bank's vault, and the notes would trade in the market at different values depending on how trustworthy the bank was. And I can definitely see a system whereby a crypto instrument which represents gold somewhere could trade, and gold gives it stability, and it's much more liquid. Again, gold coins aren't that liquid. Each one's a little bit different, and they get chipped and clipped and all the rest of it. And so the paper representation of that was actually a better form of value than the gold itself, assuming it was trustworthy. And crypto could serve the same function. It adds liquidity to gold. It doesn't replace it.
Interesting. So you don't think that the function of money will evolve as technology evolves and advances over the next 200-300 years? We're still going to default back to hard assets, gold, silver, copper.
I'll defer to George Gilder on this. And one of his points is that the signal to noise ratio. Copper is pretty noisy, so you can only send so much signal down a copper wire, whereas fiber optic is just dead. It doesn't move at all. So you can squish tons of information on a fiber cable. And his analogy is, if you've got money that's going all over the place, right, it doesn't send a very good signal about value. Whereas if your money's dumb, if it just sits there, if it's incredibly stable, you can squish lots of information down that monetary medium. And as Hayek said, prices are information. It informs the market where the scarcities are, where the surpluses are. And so you need a dumb money that just sits there and stable to transmit complex information.
So you've made your case for $3,000 gold, but from $3,000 to $10,000 is a big jump. What's the catalyst for $10,000?
Yeah, well, so, I mean, let me make an analogy.
Yeah.
Back in the 1850s, okay, a silver dollar was worth $1. Right, 100 pennies had copper in it, and it was worth about 50 cents. Okay. So if you went to the bank and exchanged your pennies for a dollar, you get a dollar value for 50 cents of copper, right? Well, that's because everyone trusted the banking system, the government, all the rest of it. Sure. If the coverage collapsed, you get 50 cents for your pennies, not a dollar, right? Okay, so the dollar currently is supported by debt payments made in dollars. It's supported by taxation made in dollars. It's supported by countries who are afraid of the U.S. because if they diss the dollar, bad things happen. They're brewers sometimes, especially in the Middle East, right? So that's the empire supports the dollars, right? But what backs the dollar? The Fed's assets do, right? And we look at the Fed assets. What do they own? They own a bunch of treasury bonds. They own the debt of an insolvent Congress that can't stop spending money, spending more money, right? Especially in the COVID response, the numbers have gone crazy. And so if and when, I think when, the U.S. power starts to devolve, starts to fall apart, right, the market will say, okay, that dollar, what is behind that dollar? And the answer is very little. And that's why you get a dollar that goes way, way, way down, and a gold price, because gold is free market money going way up in dollar terms. That doesn't mean that all the prices are stable. I don't expect oil to be where it is now when gold's at 10,000, of course. This is about the destruction of the dollar. Now, I do expect gold to go up against commodities because obviously, in this scenario, business won't be doing well, economy won't be doing well, and demand will be a lot down, and so a lot of these commodities and assets will be down. So gold will go up in those things too. But it won't go up as much in terms of commodities as it does in terms of dollars. So that's from a theoretical perspective how you get there. And as the Fed's balance sheet keeps expanding, that number keeps going up. I haven't done the calculation recently, but basically, this has happened before. In 1980, when gold hit $6.50 an ounce, the gold in the Fed's balance sheet backed its liabilities by 100%. And that number currently is around 30,000. Now, that wasn't sustainable. That wasn't the equilibrium price, but that's the craziest it got to in that panic, where people basically said, we're writing off all this treasury bonds to zero. So we were effectively back on a gold standard in 1980. The market put us there, not the politicians, the market. And that will happen again.
Well, Dan, I could talk to you all day, but I think you've certainly made your case for $10,000 gold, and we'll see if it happens in the foreseeable future.
Just have me back on when it happens. I'll look forward to it.
We'll have you on even before it happens.
All right.
Thank you, Dan. Thank you for coming on the show today.
Kitco News, special coverage of the
Okay, so we are moving towards the gold news reuters.com. The precious gold resumes retreat on dollar strength with all eyes on Fed. Delta hits 3-week peak. Silver hits lowest since November last year. Set for weekly decline. Platinum down over 6% this week. Gold's slight rebound on Friday from a sharp sell-off in his previous session lost steam as the US dollar declined, putting it on course for a second weekly dip with investors focused on the US Federal Reserve's tapering strategy. So gold slight rebound on Friday from a sharp sell-off in the previous session. Lost stream as the dollar gained. Spot gold was down 0.1% at $1751.29 per ounce by 1:31 p.m. EDT. US gold futures settled 0.3% lower at 1751.4. A surprise gain in August US retail sales earlier in this week reclined it. Early Fed tapering fears boosting the dollar and driving a nearly 3% drop in gold on Thursday. The market already believes the Fed will cut back on bond purchases and that would drive yields higher. This doesn't bode well for gold. It's almost likely to going on to the comeback down. He added the dollar rather than gold was benefiting from safe haven demand from developments in China surrounding proper developer Evergrande. The dollar climbed to a 3 week peak, making gold more expensive for currency holders. Gold has been a frustrating mean reverting product most of the time, adding that it was likely to be hemmed in the 1750 to 80 range going to the Fed meeting. The Fed's policy setting committee will meet on Tuesday and Wednesday. A strong hawkish shift would prompt another key jerk downward reaction in the gold, even if it has been priced in already. Unwinding of economic support measures not only dim gold's status as a haven, but any subsequent increase in the interest rate would translate to high opportunity cost of holding non-yielding asset like bullion. Silver slipped 2.4% to $22.837 per ounce after hitting its lowest level since end November 2020, putting it on the track for the first week since mid-June. Platinum rose 0.5% to $937.67, while palladium fell 1.4% to $2004.46. तो हमारी साइड से आज के लिए इतना ही और हम लोग बाकी की चीज़ें कल के सेशन में डिस्कस करेंगे. So if you want me to end this session right here, kindly press 100. ओके सो हम लोग आज का सेशन यही पे एंड कर सकते हैं. थैंक यू सो मच फॉर ज्वाइनिंग दिस सेशन एंड कंटिन्यूइंग. आई एम एंडिंग दिस सेशन राइट हियर राइट